you own a property, real estate property of some sort, and you have a lot of equity in that property. And you're wondering, how can I get access to that equity? Equity, depending on how you bought, of course, is kind of like free money to you. But at the same time, because it's tied up in a property, it's not super liquid. So how can you get that cash as liquid to be able to use it for other things? That's what I'm going to hit on. So there are 3 primary ways that you can do this. Before I tell you what those are, if you have equity in your property and you're wondering what to do with it, or you eventually want to have properties that have equity in it, hit the like button. I don't know. It's just a good reason to hit the like button. Got to ask for it. Okay, back on track. I'm going to tell you the 3 ways, and then I'm going to dive into each of those separately to give you some more information. These are not the only ways to use equity in your property, but these are the 3 primary ways. Number 1, you can obviously sell the property. So whatever you owe on it, whatever the value is higher than that, that's cash to you. There's something very important to know about that I'm going to touch on in a second though. So just stick around. So you can sell your property. Number 2, you can do a cash out refinance of the mortgage that you currently have on that property. And number 3, you can do either a HELOC, which is a home equity line of credit, or a home equity loan. And I'll tell you the difference between those things. But for the most part, it's kind of one category, similar ideas. So sell your property, do a cash out refinance, or get a HELOC or a home equity loan to access that equity. Now, let's dive into each of those. So to sell your property, the number 1 thing that you need to be aware of if you're planning to sell your property in order to get access to that equity as cash is the possibility that you're going to get highly taxed on your capital gains. So whatever that profit amount is, however much you've earned in capital gains, in theory, you're going to get taxed on it. So the most important tool for you to be aware of is the possibility of doing a 1031 exchange. I'm not going to dive into that here because I just recorded an amazing video with a 1031 expert. I generally knew what 1031 exchanges were, and I kind of knew the ballpark ideas of them, but I did not know much past that. They're kind of the elusive mystery to me. So me and this guy, he's an expert, like I said, we really dove into how does the 1031 work? What are the advantages? How do you go about pursuing it? And he even gave examples of ways that you can use 1031 exchanges to really be strategic with your wealth building. There's different things you can do with these things that my mind was blown. So I'm going to put a link below so you can check out that video so you can learn everything you need to know about 1031 exchanges. But the part I am going to tell you about those right now is you have to decide that you're going to do that prior to selling your property. Don't sell your property and then be like, oh, I want to do a 1031 exchange. Too late and you're stuck. So that's the one thing I'm going to tell you. Don't look into 1031s after you sell your property. So look into them now. So you can sell your property straight out, but try and help yourself on the tax front a little bit there if you can with the 1031. So option number 2, kind of my personal favorite, and I've done it. I actually really like it. It's the cash out refinance. So let's say that I was leery to use numbers because I'll probably confuse myself for no reason. But basically, I have a mortgage on a property. Let's say my property is worth $100,000 and it's now, well, let's say it was originally worth $100,000 and now it's worth $150,000. So my original mortgage is based on that $100,000. Now, because I have equity, what I can do is refinance that mortgage on the higher amount. So now I would have a mortgage based on $150,000, whether I'm doing 10, 25, 30% down, whatever, versus $100,000. What that does for me is it puts that extra money in my pocket. Okay, all right. So $100,000 mortgage becomes a $150,000 mortgage. I'm probably not saying that exactly correctly because of down payments and loan to values and all that kind of stuff. But basically, you get access to that equity. Now, you are going to pay interest on that equity because you're pulling a loan out on it. And the big thing to know about the cash out refinance is that this is a revamping of your original loan. So this is still a first loan type of situation. Maybe not good or bad, but worth knowing. And a really nice time to do this is if the current interest rates on mortgages are lower than what you were paying on your previous loan. Where you want to be careful to do a cash out refi is if interest rates are now higher. So let's say that I had a 4% interest rate on my mortgage on this $100,000 house. And now interest rates are, I don't know, 3%. That's way better than 4%. So I can refinance the whole loan into that 3% interest rate while pulling all that extra cash out from the equity. Now, if interest rates were now 5%, this may not be all that advantageous because now, I mean, yes, I'm still going to pull that cash out, but now I'm paying 5% interest instead of 4% interest. So that's the big thing you want to look at first is what's the current interest rate versus what you had, because if it's higher, you may not want to revamp your whole loan at the higher interest rate just for that cash. One more consideration about the cash out refi, because this says cash out refi, like all the cool cats call it, versus refinance, just it's faster. So the cash out refi, I've looked into it a few times when I've had a lot of equity on one of my rental properties. And what you want to be leery of is if you're in it for the cash flow. So my property makes positive cash flow every single month on the current, with the current mortgage payment. If I suddenly cash out refi and my mortgage payment is that much drastically higher, it could kill off my positive cash flow every month. That may not be a deal breaker depending on what you're trying to accomplish, but you want to be careful. So I've actually held off on doing some cash out refis, as tempting as they were, because I could get so much equity out of them, because it would put me into a negative cash flow situation because my mortgage payment is going to increase. I was about to say dramatically, but depending on how much higher your loan is now. So that's my other disclaimer there. But for the most part, I love cash out refis. You of course have to be able to qualify for a mortgage because it is getting another mortgage or revamping your mortgage. And you know, you're going to be required usually with a cash out refi to be 25% in as far as your down payment. So 75% loan. Intricacies you can figure out later. Okay. Option number 3. Also, if this is helpful so far, hit that like button if you didn't in my first ask. Okay. So option number 3, the home equity line of credit or the home equity loan. I probably could have broken these into separate pieces, but they're really related. So the home equity loan, for example, is very similar to the cash out refi, but the difference is, whereas the cash out refi is one loan, it's the first loan, it's revamping your current mortgage. The home equity loan is now a second loan. So you keep your original loan or mortgage or whatever you have, and now you're adding a second one. So at the end of the day, it kind of ends up being basically the same thing as the cash out refi, but now you have 2 different loans, which means 2 different loan payments. And the consideration you really want to think about is back to that interest rate thing. So if the current interest rates are lower than what your original mortgage was, you probably want to cash out refi, because then you get the whole mortgage at the lower interest rate. But like I said, for the cash out refi, if the current mortgage rate, interest rate is now higher than what you did, you may not want that higher interest rate on the whole loan amount. So that might be a time that you would consider the home equity loan, because now you're only going to pay that higher interest rate on the second mortgage, not the full mortgage. All right. Okay. See, real estate's all about strategy. The more options you're aware of, the more you can creatively put them all together. So home equity loan, you can get it at a fixed rate. Again, it's basically just like taking a second mortgage, just for that smaller amount or bigger amount, depending on how much equity you have. The home equity line of credit is very similar to the loan. So it's basically line of credit versus a loan. And just like any line of credit versus a loan, the line of credit is more of an available balance for you to be able to pick from. So if you get the loan, let's say that $100,000 versus the $150,000 house, you get that loan for that $50,000. It's a fixed rate. It's a one-time payout. It's like that second mortgage. The line of credit gives you access to that $50,000. It doesn't necessarily put that $50,000 right in your pocket. The advantage to this is that if you only pull out part of it, you're only paying interest on that part versus paying interest on the whole $50,000. So maybe you want to pull it out to have access to it, but you end up not needing it all, or whatever you wanted money for in the first place, you don't need all of it. So why pay the interest on all $50,000 versus, let's say you pull 20,000 out, that's a lot cheaper. Now, one disadvantage to this is typically you're going to end up with an adjustable rate, I was about to say mortgage, but an adjustable rate loan on this line of credit, possibly. Maybe not necessarily, but oftentimes it's an adjustable rate, which means the payment and the interest rate can fluctuate. And if that gets pretty high, you'd want to be really careful with that versus the security of having a fixed interest rate on whatever kind of loan you're talking about. So the line of credit is an available balance. You can pull from it and you only pay interest on that. Now, typically with both the loan and the line of credit, most often, not all the time, but most often interest rates on those in general are going to be higher than if you do the cash out refinance. Again, it changes all the time with the market. Who knows? So always look into it. Get quotes for all the rates for everything. That's your first starting point. So basic summary of how you can get access to the equity in the property that you currently own. Sell the property, definitely look into 1031 exchanges to save on the taxes. Cash out refinance, and a home equity line of credits and home equity loans. Those are the primary options that you have and that I recommend looking into. Like I just said with the loan versus the line of credit, run the scenarios on all of them. Run the numbers if you're going to sell it, including if you're paying taxes or 1031. Run the numbers on a cash out refi. You can get quotes from lenders, and run the numbers on a home equity line of credit or home equity loan. I have a video, a little bit unrelated to this, but basically it goes into how to determine which investment to go with or how to decide between a couple of different investments. I'm going to link to that below, but it's basically expanding on this idea of, without stressing about anything else, just run the numbers on all of the different scenarios. That's going to take the abstract part out of the equation for the most part and give you a starting point for what to consider. Because once you know the numbers, that may automatically eliminate certain things. But then from there, you can kind of make your call based on goals, interests, whatever you're trying to accomplish. So definitely check out that extra video below. Definitely check out the video I did with the 1031 guy. It was oddly entertaining given it's basically tax talk, and run the numbers. And one last little helpful hint, in my opinion, don't get access to that equity until you have a plan for what you're going to do with it. Sometimes people want to pull the equity out and then maybe do a rental property, maybe go flip a house. They're toying around different ideas. Don't pull the equity out until you know what your plan is, because shy of the sale, but if you do a cash out refi or the home equity stuff, you're paying interest on that money. So don't pull it out just assuming you're going to do something with it. And then, you could technically put it back into the property, but that's a lot of work. So have a plan for what you want to do with this money. Again, I recommend investment properties over like cars and boats and stuff, but maybe you just want a boat. Maybe it's your lifelong dream. I don't know. So know what you're going to do with the money before you possibly unnecessarily start paying interest on it. So if this video was helpful, hopefully you've subscribed to my channel. If not, hit that big red button down there, please. And hit that like button, and also throw in some comments. What have you done in the past to access your equity, and what did you do with your equity? It'd be fun to hear about it. So yay for home equity. It's one of the biggest financial advantages of owning real estate.